almost bought some Bitcoin this morning, but I got an emergency at work. Viva emergency.
Yeah, so in general, right, if you've got a longer time horizon and you just dollar cost average anyway during crashes, the short term doesn't matter too much. If you trade actively, then even if you get these little crashes, it's fine because the next opportunity comes anyways, right? So the worst thing that can be done is always to try to chase the market. There are some interesting videos about this, but when people say, oh, the price might be coming down, it's falling, and then out of panic, they are selling. Then it's recovering. They think, okay, it's coming back up, and then they're buying, and then it crashes again. Trying to chase the market is always the worst. So it's better to always do the opposite of what the masses are doing, at least in the short term. In the medium term, it's better to follow the trends. That's why we use the moving averages. And over the very long term, it still makes sense to do the opposite, at least during bear markets, right? If we crash heavily from the all-time high by 60, 70, 80%, it makes sense to be contrarian. But yeah, so it very much depends on the time horizon. Very long-term, contrarian in the bear case. Medium-term, going with the trend. And very short-term, it does make sense to be contrarian in both directions. If we rally very, very quickly, it might make sense to take some profit. Not all, right? Always just partial profits. And if we crash very quickly, it also makes sense to adjust a little bit the position and buy a bit. So it always depends on time horizon. What do I mean with short term, medium term, long term? Short term means when you look at, say, the hourly charts. So your time horizon may be 1 to 2 days. Medium term is several days, several weeks, potentially several months. And long term is when you have a year time horizon, right? When you look at, I buy now and I'm okay to hold for, say, 2 or 3 years. We will hit the lows this month, March 28th. Yeah, not sure where this is coming from. I expect the bear market to continue for a bit longer, but nobody can know this for sure. So if there's ambiguity, if you're currently under allocated, it always makes sense to at least buy a little bit and then allocate towards the market. But I'm currently simply trading according to the best moving averages. With that topic, actually, let's have a look at this. This is Bitcoin with the best moving averages, right? So the 44-day simple moving average, that's the line in orange, and the 125-day simple moving average. Why do we have two moving averages here? We've got two moving averages because they react for different time frames rather, and the 44-day moving average is better if you were to trade Bitcoin with leverage. If you want to go multiple X long and potentially multiple X short, if you want to bet on falling prices as well. If you only trade Bitcoin based on the spot market and you sell it and you buy it and you've got higher transaction fees and you don't want to make so many transactions and incur all those fees, then the 125-day simple moving average is better. So whenever we are above, we should be betting on rising prices or we should buy Bitcoin. Whenever we are below, we should be selling or we should be betting on falling prices. Currently, we are still below both moving averages, and interestingly enough, all of this talk around Jane Street and the war, etc., it all just happened in this little sideways trading range with slight movement down. So really, the news, they bring a lot of entertainment, potentially, if you can call a board declared entertainment, but they don't really move prices much. And that's really what we care about when it comes to trading. We want to see the things that impact prices. And I think what impacts the price most for Bitcoin is simply the general psychological state of the market. If we have always topped out after roughly 3 years of a bull market, and then we saw roughly 1 year of a bear market, and we've got a 4-year cycle that tends to reinforce itself all the time, and it probably makes sense to at least take this into consideration. It probably makes sense to take the best moving averages into consideration. This here is the backtest of the 44-day SMA, right? So that's the line in orange. If we just follow that line and we bet on falling prices whenever we are below, and we bet on rising prices whenever we are above, that's the kind of outperformance we can get versus just buying and holding Bitcoin. This is a chart that starts in 2015. And yeah, this is a logarithmic scale. Each of those horizontal lines, that's a 10x difference. So the difference is massive. Here's the same leverage optimization. So when we look at how much can we go long versus how much should we go short in terms of leverage, the x-axis is the amount of leverage, the y-axis is the annualized performance. We can go much more long in terms of leverage. We can go up to 2.75x. That's the optimum. And for short, we have to be a bit more conservative. The best short is at 1x, the best short leverage. If you just take the same leverage for both sides at the black line, then somewhere between 2 and 2.25x is the ideal. For our copy trading vault, we don't use 2.75x for long. We only use 2.25x just in order to reduce the volatility of our performance. So we want to have the best risk to reward. This here is the best reward, but it's not necessarily the best risk. The drawdowns are quite high when you use 2.75x. But what I find very good about this chart, and this is what many people don't really understand, is we really do not need too much leverage. Now this is just leverage relative to our portfolio, right? So our trading portfolio. So let's say we've got a 2x leverage. Our trading portfolio is say 100K. We should have a position size of 200K. This is not depending on what position we've actually opened, right? If you only open 10K position and we want to have a 2x leverage on our portfolio, we can actually set 20x on that 10K, as long as we've got cross margin enabled, etc. But those are kinds of details that I explain later in premium if you're interested in that. In general, make sure that you don't take too much leverage relative to your portfolio. Don't have a trading portfolio of 100K and then put a 20x leverage on this. You're really just waiting to get liquidated. 3x is the absolute maximum, and it's probably not even ideal. It's better to just keep it at around 2x maximum. I know it feels like we leave gains on the table, but it's really not the case, because every now and then we get those flash crashes and you don't want to get wiped out in those flash crashes. The best risk-adjusted leverages usually is at around 2x. And if you use altcoins, they tend to be even more volatile. You might even go lower than that. That's what the numbers say, and I just trust in numbers.
This is decided first, then the news is added. For instance, is it interesting? Why? A lot of Trump tweets are out of market hours. Liquidity is available in crypto and in tokenized gold.
Yeah, that's how I work with the market in general. I think it does make sense to just look at the market structure, where is liquidity, where is attention headed, and not worry too much about news developments, because we can't impact the news anyways. We can't also anticipate the news better than others, unless we are insiders or unless we've got a very strong knowledge base in a particular news-driven event, right? If we know, say, geopolitics very well, and we look at the troop movements very closely, and we have analyzed troop movements in the past and considered, hey, how often does a certain event happen? Then of course we can trade based on that, but even in that case, I'm not sure if we should trade, say, Bitcoin for that. If you want to trade political events, you can simply use Polymarket. If you don't move millions of dollars with a single bet, but you move just a few tens of thousands, maybe hundreds of thousands of dollars, you can use Polymarket for those very big political events, and you can make much more money with that, because it's just binary outcomes. You either lose or you win. And if you have insider knowledge, or if you know something much, much better than the rest, then why trade Bitcoin based on that knowledge? Why not just make the pure play? That's in general how I think about trading and using different
assets. I don't want to have a certain thesis on something and then trade a different asset that might only benefit or react to a certain thesis on a secondary level. I want to always play the pure play, right? Let's say I want to bet on rising or falling interest rates, then I buy or short long-term treasury bonds. I'm not buying or selling, say, technology stocks. Or if I want to trade crypto, right? If I have a certain idea about, say, where the crypto market is going, I would not necessarily then start buying and selling MicroStrategy. I would rather directly buy and sell Bitcoin. I would only touch MicroStrategy if I've got a certain idea about MicroStrategy specifically.
So if I think that MicroStrategy itself is overvalued, undervalued relative to Bitcoin, I might long or short MicroStrategy relative to Bitcoin. But I would not make a positional bet on crypto by buying MicroStrategy or selling MicroStrategy. And it's always better to just have the pure play, because why pollute one's performance with different impact on a particular asset if you can have the direct exposure to something? And it's the same here with news, right? We've got Polymarket now that gives a very clean exposure to particular events. If you don't have very deep insight into those events, then why trade the market based on those events? There's many other factors that move prices anyways, and we never want to be right all the time, right? We just want to be right more often than we are wrong. And so everything that we don't understand, we just judge it as noise. We just judge it as something random, even though it might not be completely random, right? Even though it might be possible to trade based on it. We just regard it as random, and the only thing that we understand, that's then what we trade upon. And that's the thing that we focus on and that we try to use to beat the market. Everything else we just ignore, and we can, because long-term those kinds of developments, of course, also cancel out.
This clip was just a tiny moment out of a much longer value-packed video. To watch the entire episode, just press over here. Take your time. Looking very much forward to seeing you on the other side. Just press over here. Cheers!